Imagine opening your investment account tomorrow morning and seeing $8,000 gone. Your first instinct probably isn't going to be calm financial analysis. It's going to be fear. And that's exactly where the real danger begins. Market crashes hurt, but panic can turn a temporary decline into a permanent financial mistake. The question isn't just how far stocks might fall. The real question is, what will you do when your brain is screaming at you to escape? Because during a crash, your emotions may become a bigger threat to your wealth than the market itself. Every crisis looks unique while we're living through it. 2008 brought financial institutions under enormous pressure. In 2020, markets collapsed at extraordinary speed as the pandemic spread. Then 2022 brought another major decline. Different causes, different headlines, but one emotion kept showing up: fear. Look at the 2020 example. A market level represented here as 100 fell to roughly 66, a drop of about 34%. At the time, it felt catastrophic. That's why history matters. It reminds us that fear isn't unusual. It's part of the investing experience. Here's something investors often forget when markets are falling. Price and value aren't exactly the same thing. Imagine a productive company with factories, employees, customers, products, and real earnings. If its market price falls from $100 to $70, the factory didn't suddenly disappear. The business may be facing real problems, and its value can certainly change, but a falling quote alone doesn't tell you the entire story. That's why blindly reacting to a red number on your screen can be dangerous. Before selling, ask a better question. What do I actually own, and has the underlying investment fundamentally changed? I think this is one of the most underrated lessons in investing. Cash isn't just money sitting around. Cash buys you time. Imagine your car breaks down during a market crash, your checking account is empty, and most of your wealth is invested in stocks. Suddenly, you may be forced to sell investments while prices are depressed just to pay an emergency bill. That's the problem. An emergency fund creates a financial buffer between your daily life and your long-term portfolio. You don't want a broken transmission, medical expense, or temporary loss of income deciding when you sell your investments. This is the classic market timing trap. Prices fall, fear takes over, and the investor sells near the bottom. Then the market begins recovering, but instead of buying back immediately, he waits. Maybe this is just a temporary rebound. Prices rise again. He keeps waiting. Eventually, confidence returns, but by then prices are much higher. So what happened? He sold because prices were low and bought back because prices were high. Exactly the opposite of the original goal. That's why predicting both the exit and the re-entry point is so difficult. The market doesn't announce when the bottom has arrived. Now look at what happens when investing becomes automatic. Suppose you invest $500 every month. When shares cost $100, that money buys 5 shares. But during a crash, if the same investment falls to $50, the exact same $500 buys 10 shares. That's the basic logic behind dollar cost averaging. You're not trying to predict tomorrow's price. You're consistently investing according to a plan. Lower prices automatically allow the same contribution to purchase more shares. It's boring, mechanical, and completely different from making emotional decisions every time the market moves. A 35% market decline doesn't affect everyone in the same way. A younger investor with decades before retirement may have plenty of time for markets to recover. Their biggest asset may actually be time. But someone already retired or preparing to retire may need to withdraw money while prices are down. That's a completely different problem. They can't simply assume they'll wait 20 years. This is why risk tolerance isn't just about whether you're emotionally comfortable watching stocks fall. Your age, income needs, financial goals, and investment horizon all matter. The same crash can create very different consequences for different people. Instead of asking, "Is this the bottom?" try asking, "Has my portfolio moved away from my plan?" Imagine your target was 70% stocks and 30% bonds. After stocks fall sharply, Your portfolio could drift to 60% stocks and 40% bonds. Rebalancing means adjusting the portfolio toward the original target instead of trying to predict what the market does next. That's powerful because you're replacing emotion with a rule. You're not claiming to know tomorrow's price. You're simply saying, this was the allocation I decided was appropriate before the panic started, and I'm following that structure. For American workers, this can be one of the most expensive panic reactions. If your employer offers a match on contributions to your 401k, stopping contribution because the market is down may mean losing more than investment opportunities. You may also give up employer money that was available to you. When prices decline, your regular contribution can purchase investments at lower prices. Of course, if your financial situation changes and you need money for essentials, that's different. But simply turning off retirement contributions because headlines are frightening can damage a strategy designed to work over decades, not weeks. One of the easiest ways to make market crashes less frightening is to stop treating every dollar the same. Think of your finances in layers. The first layer is survival: housing, food, healthcare, and emergency cash. Above that comes near-term money for things like a vehicle, education, or other expenses you expect in the coming years. Only after those foundations are protected do we reach long-term wealth, money intended to remain invested for many years. The idea is simple: build from the bottom. If tomorrow's groceries depend on today's stock price, your financial structure may be forcing you to take unnecessary risk. This is where fear can turn into desperation. After losing money, some investors feel pressure to recover it quickly. Suddenly, they start looking at options, margin, leverage, and increasingly aggressive bets. The thinking becomes, if I take more risk, maybe I can make everything back faster. But that's exactly when discipline matters most. A crash doesn't magically make dangerous strategies safer. In fact, desperation can make risk harder to judge. Losing 20 or 30% is painful, but turning a temporary market decline into leveraged speculation can create losses that are much harder to recover from. A crash is not a casino. Market declines can also create legitimate planning opportunities. Here's a simplified example. Imagine an investment originally worth $20,000 falls to $15,000. Selling it could realize a $5,000 capital loss. Depending on your tax situation, losses may help offset capital gains and potentially provide other tax benefits. This strategy is commonly called tax loss harvesting. But there's an important warning. The IRS wash sale rule can affect the deduction if substantially identical investments are purchased within the restricted period around the sale. So this isn't a trick to improvise. It's a tax planning strategy that needs to be understood carefully. During a crash, almost everyone wants an answer to the same question: how low will it go? But that's a prediction, and predictions are exactly where emotion can take control. A better question is, can my financial structure survive if prices keep falling? That's something you can actually prepare for. Do you have emergency cash? Is your debt manageable? Is your portfolio diversified? Does your asset allocation match your time horizon? Are your contributions automatic? Written rules create something powerful during chaos: a decision-making framework. When everyone else is reacting to headlines, you already know what questions to ask before touching your portfolio. Think of your financial life like a fortress built before the storm arrives. Liquidity and cash form the outer defense because they protect you from being forced to sell. Bonds and proper asset allocation add another layer of stability. And inside the fortress are the long-term investments you want to give enough time to grow. Notice the key phrase: built before the storm. The middle of a crash is the worst possible moment to discover that your portfolio was too aggressive, your emergency fund was too small, or your debt was too high. Financial resilience is created during normal times so that extraordinary times don't destroy the plan. And this may be the hardest lesson of all. Sometimes the smartest investment decision during a crisis is not making a dramatic decision at all. Everyone around you may be panicking. Headlines may be terrifying. Prices may be moving violently. But if your goals haven't changed, your time horizon hasn't changed, your portfolio remains appropriate, and you have enough liquidity, why should fear automatically change your strategy? Wealth isn't built only by knowing when to buy or sell. Sometimes it's built by refusing to make a permanent decision because of a temporary emotion. The market changed. Your plan didn't have to.